Welcome to Multiple Perspectives. I'm David Lofgren. Trying to understand the economy right now is, well, it's tricky. It seems like almost every day we're waking up to headlines about volatility in the capital markets. The Fed threatens to continue interest rate hikes, albeit a bit more slowly than before, and some prognosticators are issuing dire warnings of a potential recession just around the corner. But tumult in the economy doesn't mean investors are out of options, of course. And here at EquityMultiple, we're lucky to have a team of experienced real estate professionals whose job it is to dig into the data that underlie these attention-grabbing headlines and figure out what this actually means for commercial real estate investors. And it just so happens that one such member of the EquityMultiple real estate team is my guest this episode, Associate Director of Real Estate, Charles de Andrade. As a Chartered Alternative Investment Analyst, Charles brings with him a wealth of knowledge about commercial real estate markets and how, even in tumultuous times, institutional investors mine these markets for opportunities to unlock alpha. Charles de Andrade, welcome to Multiple Perspectives.
Thank you, David. Pleasure to be here.
I'm excited to have you on the podcast today because I feel like I'm drowning in economic headlines. You know, we're at this interesting moment for commercial real estate, to say the least. And with the speed of the news cycle, it's easy to lose track of some of these factors. The first half of 2022 felt in many ways like, there was a potential to achieve a soft landing. But as we moved into the second half of the year, economic headwinds seemed to increase and dramatically changed the outlook of market watchers. So, in the commercial real estate space, Q4 of 2022 saw institutional transactions sink, I think it was 69% year over year. And while the middle market fared relatively better, transactions were still down like 36%, I think, from the peak of 2021. And I want to get into all of this, but particularly how different segments of the commercial real estate market are responding to this tumultuous environment. I think it might be helpful to start with some basics. So I wonder if you can just start by explaining how the CRE capital markets are segmented, the very basic sort of stratification of the players in the commercial real estate space.
No, I think that's spot on. I think this is a very timely topic. So happy to be here today and get into more detail on it and hopefully help shed some light on some of these topics. With regards to your question on sort of segmenting the market, I think some people will be familiar with this, but essentially you can segment the market in a myriad of ways. Most typically, people tend to look at the market as starting at sort of a bifurcation of public versus private markets. And so public markets is probably the easy one in that segment where most people will be familiar with sort of listed securities, right? So stocks and bonds, but also ETFs, as well as REITs, obviously specifically to the real estate sort of domain. And then the sort of counterpart to that is the private capital sphere, which can be available to investors through direct private equity or hedge fund or venture capital investments in funds or large privately held real estate funds, with really the sort of divisible access to that being recently facilitated through, for instance, EquityMultiple. And so that's a key distinction, that sort of public versus private space. And then I think once you get in sort of that bifurcation, you can then further segment it by sector, by asset class, but also by transaction size. I think transaction size, especially with real estate, can be defined as, call it sub $25 million being the lower middle market, and then $25 to $50 or $75 million being sort of broader middle market, and then anything sort of above 50 to 75 is sort of higher middle market and or institutional.
Sure. And help me understand the relationship between these different segments. How do they play with one another, against one another, to sort of fill in the capital needs for the broader commercial real estate environment?
Sure. I think that's right. As I kind of alluded to earlier, you sort of have that range, right, from the small end of the middle market to the larger end of the middle market. And so as EquityMultiple, we tend to operate at that sort of smaller end of the range. Those deals are typically less institutionally operated. Transactions tend to be sourced locally through networks, a lot of off-market transactions as well. And so given that, the combination of that really translates to opportunities for outsized returns in our alpha to our sponsors, especially those that are adept at underwriting and sourcing deals. And a large part of those groups are exactly sort of our go-to demographic for our sponsor base. And then an important element in that is that a lot of these sponsors are further adept at really compiling portfolios and then exiting at premium valuations. And so essentially doing a lot of the work in terms of institutionalizing these asset groups for the larger buyers. And so I think a good example of that could be the self-storage space, right? Where self-storage inherently has had a lot of sort of individual, call it mom and pop operators, independent operators that just function within a market and maybe own just a singular asset or maybe 2 or 3 assets at most, and then operate them sort of independently, where one of our sponsor groups can then potentially come in, and as you see happen in self-storage in particular, come in and aggregate not just 1 or 2 or 3 local assets, but really build a portfolio in a certain region or even across a state. And then once that portfolio gets to scale, and you have maybe 20 or 30 or 40 assets rolled up, several hundred millions of dollars, that then garners a lot more appeal with some of the larger end of the middle market operators and players, and more of these institutional buyers that no longer have to do the work of aggregating these portfolios and building sort of operations at scale, but can come in and purchase these and then apply sort of that economy of scale and sort of the institutionalized operations, as you see with some of the larger operators such as CubeSmart, that then offer the ability to implement dynamic internet pricing, have sort of a broader marketing machine behind it, economies of scale in terms of portfolio and property management. And so that really is sort of an additional layer of value. So it's really bifurcated or cross capitalizing on those opportunities to unlock additional value because you're buying the asset at sort of a slight lag or differentiated sort of gap to what the actual value is. And then on the other end, you're exiting these assets in bulk at sort of an additional premium or spread to where the inherent individual value is.
So it's interesting. What you're saying is, there are, of course, these economies of scale when you move from, say a mom and pop localized operator of a single self-storage facility. The sponsors that we tend to work with are able to sort of do the due diligence, understand the market fundamentals, and identify places where, they could sort of have a favorable business play in acquiring an individual self-storage unit in an attempt to build a larger portfolio, right? So there's this like economy of scale as you move up when you start to build a portfolio, or when you specialize in a region, or you start to understand, say, an asset class like self-storage well enough to be able to really identify where the value lies in the market. And that economy of scale continues up the food chain, so to speak, right? So these institutional players are not going to be able to have the time or the, really the interest to understand some small local submarket. What they are going to do is be interested in achieving the economy of scale available when they're purchasing some sort of larger portfolio of say, self-storage units. And it strikes me that there's also this sort of, inefficiency of scale moving downwards, that while standardizing a bunch of self-storage facilities and standardizing, let's say, the management approach, you're going to be able to squeeze out extra value in that play. It also really is incumbent on these smaller localized players to first do the building of the portfolio before any institutional player is really interested in taking a look. Is that right?
Yeah, I think that's spot on. It's the ability by the sponsors to unlock that alpha because you're pursuing an opportunity that's not widely marketed, so it may be off market. You may be dealing with a seller who's an individual who has operated the property within a family at sort of a non-institutional level and is incentivized maybe to sell because of plans to retire or because of other motives or because of a liquidity need. And so there's oftentimes the ability for our sponsors to capitalize on that sort of pricing dislocation. And so that's all additional value that gets added to these deals, which obviously for us as EquityMultiple enhance the return profiles that we look at for our investors. But then carrying that through sort of up the capital markets food chain, if you will, then offers those sponsors the ability to capitalize even more in the back end if and when they are able to execute sort of an aggregation strategy and build a portfolio, which then draws appeal with the institutional buyers as well, right? So as you can imagine, as an institutional investor, if you raise a certain fund of a couple $100 million or $1 billion plus even, it is increasingly harder to deploy that if you're looking at sort of deals in the $5 or $10 or $15 million range. It's going to take a really long time to sort of fully deploy that capital. All of which, while you're taking that time to deploy that capital, it's incurring sort of its cost of capital, right? And so it's dragging the returns for those respective investors as well. And so there's, in that sense, an inherent motivation for institutional investors to deploy that capital at a certain speed. And that kind of leads its way directly into buying in bulk or buying larger assets so that that capital is faster deployed and can then start generating its own yield. And so that gives rise to sometimes there being the opportunity to offer essentially a pricing premium, which is something that our sponsors can in turn capitalize on. So the sort of interplay between sort of all these different parties and how that sort of works across the food chain is something that, irrespective of sort of some of the things that are happening in the market, these groups, and in particular our sponsors, can definitely capitalize on and realize enhanced returns.
Sure. Okay, so now we've established our capital markets food chain. I like this analogy, so we can stick with it. So I wonder if you can help me understand how the sort of events of 2022 and how that impacted players at different levels of this food chain. Can you just sort of break it down, segment by segment as far as what we saw occur?
Sure. I'm not sure this podcast and the length of our podcast lends itself to that, but I can definitely attempt to go over the highlights at a minimum. But there are certain data points that you can look at that can give you a sense of the overall sentiment and what's sort of happening and what sort of broader trends are at play. So if you look at sort of the middle market sales as a whole, sort of the statistics indicate that last year, approximately $90 billion was transacted throughout the year in sort of that $5 million to $25 million range. That is actually an increase of 7.7% year over year. So in that sort of lower middle market tier, you're seeing an increase in transactions despite everything that has gone on in the world. However, in the larger segment of that middle market sort of space, call it transactions over $25 million, you're seeing actually a steep decline in year-on-year transaction activity, down 21.5%. And so what that seems to indicate is that sort of at that larger tier, either there's hesitancy or it's become harder to do deals or there's capital on the sidelines, but it hasn't been as active as sort of the lower end of the market has been. On the larger scale deals, just given where the market is, there's just been inherently less opportunities to realize alpha. That is something that I think applies fundamentally throughout sort of any time, but in particular in these sort of distressed times, if you will, larger deals have just been much more reflective of capturing market beta and relying on sort of scale and platform synergies to generate returns. Whereas, as we addressed before, if you operate sort of in that lower tier of the market, you have much more sort of opaquely marketed or mispriced or under-operated assets, and these sort of individual or standalone properties and investments have just continued to offer additional upside opportunity to our sponsors. And so we have seen in particular sort of the sponsors that we work with being much more positioned to extract, for instance, purchase price reductions and still provide liquidity to some of these individual sellers that may need liquidity because of distress in other parts of their investments or their portfolio, versus sort of some of the more institutional owners. If you look at those as investors, they tend to typically have much more of an ability to hold past a certain cycle while collecting sort of that interim yield. And so they may not necessarily be as urged to sell or realize liquidity. But even there, in some cases, especially recently in the office sector in particular, you're seeing signs of serious distress there, as was kind of the case in the mall and retail space a few years back. And so what I mean by that is you're really currently in office seeing a lot of institutional owners cutting back on capital expenditures, and so essentially not spending any additional money on the assets that they own, collecting yield in the interim, and then ultimately defaulting on these properties as sort of almost like an alternate way of exiting these, very similar to what was done in the mall space not too long ago. You're seeing sort of alternative plays as well, where rather than sort of give up the asset, if it's a core trophy asset, try and reposition it into a different sort of use. A good example of that is the Rockefeller Center here in New York. The owner there is converting a portion of that to an Aspen branded luxury hotel. And so office is sort of really the sector that is experiencing currently sort of, I would say, the most pain. And you're seeing sort of some of these decisions being made at the institutional side to let go or unwind these assets, which if you sort of go back to sort of that lower end of the middle market, you're seeing that a lot as well, right? Where even more so like the local office buildings that are harder to lease, you're seeing sponsors either give up on those, or you're seeing an increase in repositioning plays. And so those are all things that we're, as EquityMultiple, closely monitoring to see if there's any good opportunities there to unlock additional returns for our investors.
Sure. So there are a couple of things I want to unpack there. You mentioned default as sort of unintentional and potentially in this economic context, a favorable outcome. And I'm wondering, for those of us who are just more familiar with, say, residential real estate or, single family homes, defaulting on your mortgage is never considered a good thing. How are institutional players using default as like a strategic exit from a deal?
Sure. I would say legally and sort of impact-wise, it's different from a personal mortgage, where the implications, obviously, to things such as your credit score and your personal sort of credit are much more detrimental than when an asset is housed in an LLC, which sort of shields the ultimate investors from that, especially at the institutional level. And so that's a clear distinction there. But even then, so it's still, to your point, it's still default. And so it's something hard to grasp as why would you walk away from an asset? I think the best analogy there is to look at it from maybe a perspective where you are a homeowner or you have an investment property, and the investment property is currently not leased, so it's vacant. And on top of that, the investment property is also underwater, and so the value has decreased such that essentially the value of your debt exceeds the value of the actual property. And so you're faced with a decision as an investor to continue servicing the debt while not collecting any rent or any income because the property is vacant. And so that's a lose-lose situation where you're essentially deploying more capital without sort of a positive outcome in sight.
Interesting. You also mentioned that there's sort of this differential in the time pressure that, say, institutional investors are facing versus the sort of more middle market players. I wonder if you could just expand on that. Like, what are the pressures for sort of keeping capital locked up or just being able to ride out, say, a turbulent market like we're in right now? How do they differ between, say, the institutional sector and the middle market?
Sure. I think in a lot of ways they're still very similar. I would attribute the difference to being more sort of the nimbleness of capital at the lower end of the market versus maybe more sort of the slow-moving, more demanding capital at the sort of larger end of the market. So if you're, for instance, a true institutional investor, where a lot of the capital that you have in your fund is coming from either insurances or pension funds or sovereign wealth investors, those groups have sort of their own demands and own needs to service their own base from a liability perspective if you're an insurance, or if you're a pension fund from a sort of yield perspective for the retirees. And so those demands and those sort of capital constraints, if you will, lead them to invest money into a certain fund, but almost instantaneously expect a yield to be delivered from that capital, right? And so every fund will have its sort of ramp up and investment period. So it is understood that it will take time to sort of get the fund up to scale and start generating yield, but that's not an indefinite horizon. And so there is, with that, an inherent pressure for whoever's operating the fund, the sponsor in this case, to deploy that capital, obviously as prudently and as efficiently as possible, but definitely also at a certain timeline. I think at the sort of lower end of the market, where those investment vehicles are not as institutionalized and you're not necessarily dealing with funds, or you're dealing with maybe separately managed accounts or sort of more nimble capital providers, there's a bit more flexibility there to deploy capital in a sort of different pattern or sort of different timeline. So if you're maybe a family office, there's still an urge and a push for yield, as there would be with any investor. Even our own accredited investors at EquityMultiple obviously also have their yield desires and needs. But there is oftentimes more flexibility with that capital because take, for instance, the case of an EquityMultiple investor. If you're contemplating putting in $100,000 in a certain investment, you may be able to do that this month, but you may also be able to hold off and find a temporary alternative investment and look to invest that 3 months from now when another opportunity comes along that sort of better suits your investment profile. And so the nimbleness associated with that is something that definitely applies to some of the smaller sponsors at that end of the market. And with that nimbleness, they're able to capitalize on those sort of dislocation opportunities as well.
Sure. Yeah. And we've actually seen that play out on our marketplace in the sense that, these Alpine notes that we offer are oftentimes a place where investors will park, say, $100K for a 3-6 month period while they survey the marketplace and see, where that opportunity that can truly deliver them the alpha they're seeking exists, while being able to appreciate a higher savings rate than you'd be able to get elsewhere in the market.
Yeah, exactly, and that's unfortunately just sort of the workings of the capital market. That's incrementally harder to do when those check sizes are magnitudes larger than that.
So as I mentioned in the intro, some of the factors that we're looking at in the market right now is the combination of increasing interest rates and, of course, that making capital just more expensive. But there's also this aspect of, a couple of bank failures that made everyone pretty skittish and, start to have flashbacks of 2007, 2008.
Right.
And I'm curious if you can tie those pieces together because, obviously in the commercial real estate space, banks play a significant role in providing capital, particularly, senior debt to the capital stack of these deals that are being done. How are both institutional players and, how are we as a middle market player looking at, and our sponsors, looking at debt investments particularly? How are those factors interacting with the availability of debt and sort of where sponsors are looking to try and source their senior loans?
Yeah, I think that definitely speaks to, I guess, the overarching theme here for our podcast today, where obviously we've seen a tremendous amount of volatility, specifically on the debt side as well, right? Where we were already under the sort of high inflation, rising rate environment dynamic, and then the events at a smaller bank level, as evident by Silicon Valley and First Republic and some of the other challenges for some of these other capital providers. It's just a tremendous amount of uncertainty and volatility in the market. And I think that sort of adds more fuel or drives that narrative of providers being even more cautious, right, in terms of lending. And in particular banks, where even if you take the sort of Silicon Valley events off the table for a bit, there's still inherently that bank nature of having to manage the balance sheet adequately and what you deploy and what that earns versus what you invest and what that earns, and getting to a certain yield, and then having a certain risk-weighted capital behind that to sort of make it all make sense. And so as you see that dynamic now, because of some of these events being distorted, in addition to sort of that underlying dynamic that was already there in terms of the pressure of a rising rate environment and having to inherently pay more on your deposits while on the earnings side of the bank, right, all those mortgages were locked in sort of right after COVID at sort of trough rates, historically trough rates. And so until the point where banks can sort of start realigning that sort of earnings versus deposit income perspective a bit more, you're having sort of this dynamic where banks are just at a higher risk. And so in a nutshell, that kind of translates into just more hesitancy on the capital side and deployment of capital and taking on risk, which then if you sort of fast forward to what that does for debt markets, it creates just even more hesitancy on terms of providing loans. And then that aside from just a higher rate environment not being a great environment for real estate in general, it's just more of a challenge in terms of liquidity. And so what we're starting to see now is sort of that converging into there just being very pricey debt available, and the debt that is available is just not in the amounts of liquidity that essentially is needed in the market. And so in terms of the high rates and sort of the floating rates and the uncertainty on the Fed actions, what we've seen and what we've seen at EquityMultiple as well is a lot of activity on the sponsor side in terms of securing interest rate caps. And so some of those derivatives can offer definitely sort of near and midterm certainty on financing rates. But that said, given the rising rate environment, there's still, from sort of the real estate asset level investment perspective, there's still a lot of pressure on finding positive leverage opportunities. So essentially opportunities where the cost of debt doesn't exceed the yield that you're getting on the property. And so that's a challenge in and of itself. And then even for those sponsors that solve that and the deal sort of lines up for you to either have a deal that yields significantly more than the cost of debt, or through local relations or existing sort of lending relations are able to get to a leverage point that does make sense for those deals, it's still about finding that liquidity. And so I think to sort of maybe take a step back, I think we have arrived at this point as the market has shifted essentially to provide a much more compelling opportunity for lenders. So if I look at it from the lender perspective, really for the first time in over a decade, because we've had almost a decade of LIBOR hovering around or close to 0%, you now have an opportunity to lenders to capitalize on higher base rates. And that has pushed overall debt yields back to sort of low to mid-teens, which really hasn't been seen for more than a decade, and generates an opportunity essentially for some of these lenders to earn equity-like returns with debt-like risk. So for those lenders that are not banks and not beholden to certain capital ratios and reporting and liquidity tests, et cetera, there's an opportunity there to come into the market and earn much more sort of higher octane returns versus previously in recent years, sort of mid to high single digits.
Right. And this is a pretty interesting scenario because historically, when we look at investing at different positions in the capital stack for an offering, debt has been seen as low risk and as a result, low return. And that fits well within some investors' risk tolerances. They're looking for a low risk investment with the understanding that you're going to get lower returns because you have the actual physical structure of the building and the underlying property as the security upon which your investment is made. But what I think I hear you saying now is that some of the dynamic here is shifting, that, of course, a debt investment, senior debt is still going to be underwritten with the value of the property and the building that's being invested in, but the potential returns are really shifting in the market. Is that right?
Yeah, that is exactly right. I think, again, given the sort of rising rate environment, this current opportunity for some debt providers to earn more of the sort of equity-like return, albeit at a debt-like risk, versus that not having been the case in recent years, given sort of the low prevailing base rates. But I think simultaneously there's a bit of a push and pull sort of dynamic across these different groups in the market, because whereas the rising rate environment has given sort of more of that appeal, it has also opened up the lending market in terms of competition, right? And so you're seeing maybe historically active groups not being able to be as active currently, with senior lending costs nearly doubling throughout the past year. And then you have the resulting sort of impact, the cap rates expanding, valuations coming down, et cetera. But then in turn, you're also seeing some lending platforms that rely on their own lines of financing, having a shift in competitiveness, with some becoming more and some others becoming less competitive, as well as CMBS lenders having become less competitive given their dependence on bond markets, which have been volatile in and of themselves. And so these different groups and how they're shifting sort of differently across the market plane, if you will, gives rise to an interesting environment where it's just a different competitive environment, with banks having to pull back in terms of risk taking, and then some of these individual groups moving in sort of different directions. If you say take a broader step back and look at the macro dynamic, there's increasingly sort of publications or news around the aggregate of $1.5 trillion of commercial real estate debt maturing in sort of the next year and a half to 2 years. So by 2025. And so I would say that irrespective of where these individual groups are moving towards, and some of them trying to capitalize on those higher rates, some of them maybe not being able to do so, there is a much broader sort of opportunity set ahead of the market, where this $1.5 trillion of commercial real estate debt that is maturing is going to need to sort of be dealt with to a certain degree, where borrowers who maybe had underwritten investments and were counting on an increase in value and therefore an easier refinance will now in turn under this current market struggle to refinance in this current rate environment. And that then in turn gives way to decisions around either repaying that loan down to a more sustainable level, or as we've seen in some of these other examples that I gave earlier on in the session today, defaulting on the property as a whole, right? As we've seen in some of those institutional office cases. So on the lending side of the equation, I think the bank uncertainty in recent months constrains the availability of that competitively priced capital. And then I think that in turn shapes into the unique opportunity for sort of private lending groups to capitalize exactly on that market dislocation.
Okay, interesting. So, when you talk about this $1.5 trillion of CRE debt maturing by 2025, I understand that to some degree there are business plans that have been set out when these, sponsors are investing in the property initially, and they have an expectation that, upon the maturation of their debt, they're going to be able to refinance and to some degree pull some amount of capital out of this deal, right? Is that correct?
Right.
So can you just talk about what it means for debt to be maturing? I think in the context of something like, residential real estate, debt maturing doesn't fully make sense to folks because, you just think, okay, I've locked into this thing for 30 years. And at the end of 30 years, right. I've paid my mortgage. But refinance, I think, is a concept that is fairly, accessible to most folks. So can you just talk about what that means for debt to be maturing, sort of what the expectations are in the original business plan upon the maturation of that debt and the potential to refinance? How can we plug this into an example that will help people understand really what the pressures are that these operators are facing?
Sure. I think on the commercial real estate side, what you see in terms of debt is that the term of the debt is not necessarily akin to the term of a mortgage, where it's much more of a long-dated view. So in commercial real estate, the term is usually sort of set to a certain period commensurate with the business plan. So for instance, if a sponsor intends to release the building or maybe reposition the building and then lease it afterwards and sort of work towards stabilizing the building, they may set the debt sort of accordance with that business plan and maybe with 1 or 2 year buffer sort of behind that. And so if you're, for instance, looking at purchasing a property, doing some capital expenditures and repositioning the building and then leasing that up and envision that taking 2 or 3 years, what we tend to see across our investments is that our sponsors will go out and source maybe 3 or 4 year debt, maybe with 1 or 2 year extension options, or maybe 4 or 5 year debt to give themselves some flexibility. And that's purposely done because as a result of the repositioning or the releasing at sort of market rates, the expectation is that those higher sort of yields that the sponsor is able to command, along with sort of general sort of capital market development and appreciation of the real estate as an underlying property, will sort of combine into overall the building being at a higher valuation, which again, sort of from the commercial real estate perspective, lending is often looked at from an LTV or loan to value perspective. And so if you're getting a loan currently today at like a 60% loan to value, and the value increases if you're getting that loan sort of refinanced 3 to 4 or 5 years from now at that same 60% LTV, by a factor of the value being higher, you're also getting additional proceeds as part of that refinance, with which you can pay off the existing loan and then potentially return a distribution to the equity investors, which enhances returns. And so that is something that is inherent to commercial real estate and that sort of sponsors look to generally achieve, which works under the most sort of normal markets. But if you look at sort of the current market and the sentiment we're seeing here today, it's much more sort of prevalent that in part of sort of that $1.5 trillion of commercial real estate that is maturing, that some of those assets will no longer command necessarily a higher value or the value that was originally envisioned by the sponsor. And so what I mean by that is maybe you would have had a property that a few years ago or at acquisition was valued, and this may get a bit technical, that was valued at, for instance, a 4% cap rate. And that property may have been financed with a loan at 3.5% interest at 65% loan to value. And so that's a fairly common sort of example. And then if you look at the underwriting for that in combination with sort of growing the rents over time, so essentially growing the yield, would have probably quite easily generated sufficient cash flow to service those debt payments of 3.5% for that 65% loan. A metric that lenders tend to look at for the evaluation of that is called debt service coverage ratio, which is essentially the pre-debt cash flow over the interest service. And so typically lenders would like to see that sort of be above 1.0x. So 1.0x being sort of break even. You're generating just enough cash to actually service the debt.
Sure. The basic question of, can you pay your bills?
Yeah, exactly. And so at sort of north of like at a minimum probably a 1.3x coverage, lenders feel reasonably comfortable that the property in most cases will be able to pay the mortgage. And so that's really the metric that then in reverse drives the calculation for the refinance as well, because once investors or lenders are looking at refinancing a property under the new loan, they would like to see the property continue to be able to pay the mortgage. And that becomes a problem when, at the time of the refi, the property has decreased in value, as is currently the case by expanding cap rates and the events that are happening in the market. So if you take that same property that used to be at that 4% cap rate, but now maybe is at a 5% cap rate, so 25% hit to value, even though that property may have, if it's maybe a multifamily property, obviously we've seen inflation drive rent growth. So that property may have had a rent growth as high as 10% overall. And for simplicity's sake, let's just assume that 10% kind of flowed through expenses as well, so that it's a 10% growth in NOI. Even with those metrics, the property currently today would be barely able to meet debt service for that similar 65% loan if the rate on that loan has jumped from that 3.5 to what is more prevalent today, more like a 6.5 on this example's basis. Obviously, rates today are different from my example. And so that really essentially creates the current pain point for operators, but the opportunity for lenders or debt providers where they're no longer able to get that size loan. And so because they're not able to obtain those loans at those valuations anymore, there's inherently a gap. And so the sponsor in that case is faced with one of two decisions. Either they take less proceeds at that rate because the refinance is due on the loan and then contribute the remaining capital from equity, which would be detrimental to returns. Or they go out in the market and they try and find a secondary lender to provide a subordinated loan or a mezzanine loan or maybe even a bridge loan until they can refinance at a higher valuation again. And so the opportunity set there for sort of bridge and mezz and even to some extent pref equity providers is increasing under the current sort of market dynamics. And that is exactly where we as EquityMultiple are sort of monitoring that closely and see a vast opportunity set, particularly in the lower middle market.
Okay, so take us home. I mean, here now we understand so many of the factors that are at play in the current market. As I said in your intro, you're an associate director on our real estate team. You are out in the marketplace, sourcing deals, evaluating deals that come into the platform, and trying to understand how we can best position ourselves as a lender in this environment. Where do the opportunities lie? Like, how is the real estate team right now viewing all of these factors in combination to try and position us for favorable outcomes?
Sure. I think that's a really good question. And I'll probably preface it with, I think that speaks to one of the areas that I'm particularly excited about as well as being part of the EquityMultiple real estate team, which is inherently sort of our agnostic nature, where we truly look at really every asset class, every sort of strategy, every position in the capital stack, which is just a very opportunistic approach and geared towards always sort of striving to give our investors the best sort of possible range of opportunities to look at, as well as to capitalize on. And from a personal perspective, is very interesting to me personally, because you're looking at different investments and different opportunities, and this month's opportunity set is not necessarily next month's opportunity set. And so that variety and having that breadth in the market, I find is very interesting. And so as part of that, I think one of the more exciting or interesting things that we're currently working on or looking at is in the context of some of these things we discussed and the opportunity set in the on the debt side of things, is that we're looking at our inaugural debt fund, which will offer investors the opportunity to essentially immediately take part in a diversified and curated basket of debt opportunities, exactly in the realm of what I mentioned before, and capitalizing on the sort of current environment of equity-like returns for very much debt-like risk. And that's both, or that will be both available within the fund, again, on a diversified and curated basis, as well as continuing sort of in a more traditional realm of equity multiple offerings on an individual basis. So for those investors that, given their investment rationale or profiles, like to curate their own basket of investments, we will look into start offering more opportunities on the individual loan participation side as well. And so all obviously collateralized by tangible real estate assets that our investors are well familiar with. And so we really hope that that offers a different dynamic or opportunity set within the current market and continues to expand and further enhance the opportunities to generate return to our investors, which is ultimately what we're obviously all trying to do. So very exciting times ahead.
Incredible. Well, I'm excited to see what lands on the platform in the coming weeks. Charles, thanks so much for taking the time today. I really appreciate the conversation.
Yeah, thank you so much, David. It was a pleasure, and hopefully this has been helpful to our investors, and look forward to diving into more detail in the future as well.
That does it for this episode of Multiple Perspectives. As always, you can learn more about Equity Multiple at EquityMultiple.com, or you can reach out to us directly. Drop us a line at multipleperspectives@EquityMultiple.com.